Hello friends, Namaste. Welcome all of you to my channel. Today let's discuss about the Camels approach of the financial analysis tool, or you can say the rating tool. And this Camels approach was developed in the United States, and even though these days also we use this technique to analyze the overall financial performance of the bank and financial institution, friends. Now basically today's discussion would be I would provide you context to the overall Basel first, second and third. Then I would discuss about the overall components of the camels, friends. Okay, now let's move to the first of all. Let's discuss about when we say the context. The Basel Committee was formed in response to the liquidations of the European-based banks in 1974. However, prior to friends 1988, there was no any capital regulations for banking, and that's why in 1988 the Basel Accord introduced the Basel first by the Basel Committee on the banking supervisions, and next one is that the Basel second replaced the Basel first in 2004 and made a capital adequacy framework more risk sensitive, friends. Now the basic intention is to just protect the depositors' interest and preserving the integrity of the capital of the banks. And even in 2010 December, after global financial crisis, the Basel III was introduced in response to the crisis, and basically it has three pillars. That's the quality and the level of the capital. Next one is that the supervisory of the review process and the public disclosure, friends. Okay. Now, based on this context, let's move to the camels. Camels, we have altogether six components, or can say that elements in the camels financial performance tools. That's the C is the capital adequacy. To measure the capital adequacy, we could use the core capital ratio, which is greater than equals to 6%, while total capital ratio, that is the CR, is the greater than equals to 11% as per the Basel chart. Now, what about the asset quality? Asset quality is that as a bank, or you, if you just flow the loans to your customer, but over the period of time, if you are unable to manage your loan portfolio, then that causes the non-performing loan situation. Basically, if banks are unable to collect your interest and we see that principal amount within 90 days, then this is good. If they are unable to collect that, then that would be the non-performing loan. Okay, that's why the bank would have a loan loss provision too. And next one is that is the CDR, credit to deposit ratio. Now let's move to the M part. M is about your, for example, we also study the management perspective also, like who are the board of directors, their management vision, like that. But anyway, generally when we quantify the management, like we could use the total asset growth rate, yeah, loan growth rate, yeah, earning growth rate. Similarly, what about the E? E is about your earnings ability. That's a earning per share, return on assets, return on equity we could use to measure the overall earnings potential of the financial institution, friends. Now liquidity is very important because like a cash reserve ratio, like in our case, for the cash reserve ratio was set as a 4% in December 2024, and that's a cash and bank balance, investment in government securities, like that. Now last is the very important, that is sensitivity to the market risks, friends. Is the changes in the interest rate, yeah, foreign exchange rate, yeah, commodity prices, equity prices, which sensitive towards your banking system too, as well. That's the market risks. Market risks, if you remember, that's we calculate the beta value. Higher the beta value, then higher would be the market risk, friends. Okay, that's why NRB prescribe the capital adequacy parameters to ensure adequate capital in the banking system. And basically the banks need to increase their capital proportionate to the degree of the risk taken. And even you have to study the BAFIA, that's the Bank and Financial Institutions Act 2063 2005, that is. Okay, now I believe that this approach that you could use to basically to analyze the overall financial performance of the banks, and accordingly you could do your prediction also for the banking also. Altogether, we know that's 20 commercial banks in Nepal, out of which 19 commercial banks are listed in EPSA. Okay, friends, these are the things that I would like to share today. If you like this content, please like, subscribe, and also share this channel. Thank you, all of you, for watching this video. Please take care, all of you. Thank you.